In the world of high-stakes tech and finance, stability is pretty much everything. But in March of 2023, one of its biggest pillars, Silicon Valley Bank, just vanished in less than 48 hours. So today, we're going to break down exactly how that happened.
I mean, look at this building. It doesn't exactly scream epicenter of a financial earthquake, does it? But that's exactly what it became. This was the headquarters for Silicon Valley Bank, and its failure sent absolute shockwaves through the entire global tech industry.
Let this number sink in for a second. $42 billion. It's just a staggering, almost impossible number to wrap your head around. But it's not a company's valuation or a government budget.
No, it's something way more frightening. It's the amount of money customers pulled out of SVB in a single day. A digital bank run of $42 billion. That kind of panic, well, it can bring literally any financial institution to its knees.
So the big question is, how on earth did this happen? How did the absolute darling of the tech and startup world, a bank that looked perfectly healthy, just fail so spectacularly and so fast? Okay, so to really get why this was such a shock, you gotta understand who SVB was. This wasn't some tiny local bank. It was the 16th largest in the entire country, and more importantly, it was the go-to bank for the tech world. We're talking about a bank that financed nearly half of all US venture-backed startups. Giants like Roku and Cisco banked here, and the wildest part, just days before it completely imploded, regulators were describing it as being in sound financial condition.
The thing is, the collapse wasn't just one single thing. It was more like a recipe for a total disaster. A perfect storm created by three key ingredients that all came together in the absolute worst way possible. So it all started with this huge surge of cash during the pandemic. Tech companies were just booming, and their deposits at SVB literally doubled in just 1 year. SVB took all that cash and made a huge bet. They bought billions in what they thought were super safe long-term government bonds. But then, the Federal Reserve started aggressively hiking interest rates to fight inflation. And that one decision, it turned SVB's safe investment into a ticking time bomb.
And this gets us right to the heart of the problem, this concept called unrealized losses. Here's how it works. When the Fed raised interest rates, new government bonds started paying out more. That made SVB's older, lower-interest bonds worth a whole lot less. So all of a sudden, on paper, they were staring down a $15 billion loss. Now, it's only an on-paper problem as long as you don't have to sell the bonds. But what if you were forced to?
Well, that what if became a reality, and fast. And look, this wasn't your grandpa's bank run with people lining up around the block for hours. This was a digital wildfire, and it spread through text messages, Slack channels, and Twitter, all in the span of about 48 hours.
It all went down with just breathtaking speed. On March 8th, SVB admits it sold some of those bonds at a huge loss and needed to raise cash, fast. That was the spark. By March 9th, really influential investors were blasting out messages to their companies telling them to pull their money out, now. The result? That $42 billion withdrawal. And by the very next morning, it was just over. Regulators stepped in and seized the bank.
And that quote right there, it really hammers home the terrifying power of social media in finance today. This wasn't just a few random depositors getting scared. It was a handful of very powerful venture capitalists telling everyone to run for the exit all at the same time. That advice spread like lightning, with absolutely catastrophic results for the bank.
So the bank is toast. Now the US government has this massive problem on its hands. A crisis of confidence was starting to bubble up, and they had to move incredibly fast to stop the panic from spreading to the entire banking system.
So you might be asking, why the huge government response? I mean, don't we have insurance for this? Well, here's the thing. This wasn't a normal bank. Standard FDIC insurance only covers deposits up to $250,000. But at SVB, a shocking 89% of all deposits were uninsured. They were way over that limit. We're not just talking about individual savings accounts. These were the payroll accounts for thousands of tech companies. If that money disappeared, it could have triggered mass layoffs and a huge economic crisis.
Now, officials were really careful to call this a depositor guarantee, not a bailout like back in 2008. And the difference is actually crucial. The bank's investors and its executives, they got wiped out. Their money was gone. But all depositors, even the ones with millions of uninsured dollars, were made whole. And this part's important. This wasn't paid for by taxpayers. It was paid for by special fees on other banks.
The goal was simple: stop the panic from spreading. So here's the game plan the government laid out step by step. First, seize the bank. Second, create a temporary bridge bank to make sure companies could still make payroll. Third, guarantee every single deposit to bring back some confidence. And finally, sell off what was left of SVB to a healthy bank, which ended up being First Citizens Bank.
So what did this whole rescue mission cost? Well, the estimated hit to the FDIC's deposit insurance fund, remember, that's the fund paid into by other banks, was about $20 billion. A massive price tag for sure, but one they paid to prevent an even bigger crisis.
Okay, so once the dust settled, or actually even before it settled, the finger-pointing started. Everybody wanted to know who was to blame and, maybe more importantly, how we could stop this from ever happening again.
So, who's to blame? Well, the debate basically boils down to three main arguments. First, the Federal Reserve's official report pretty much put it all on the bank's own mismanagement. Second, a lot of critics pointed to a 2018 deregulation bill that weakened the rules for banks of SVB's size. And then there's a third group who argued that regulators actually saw the problems coming years in advance, but just failed to act decisively enough. The real answer is probably some combination of all three.
And all of this leaves us with the big multi-billion-dollar question. Was SVB just a unique case, a very specific kind of bank with a very skittish customer base that made one really bad bet on interest rates? Or was its collapse a flashing red warning light, exposing much deeper problems in the banking system that we still haven't fully dealt with? That's the question regulators and economists are still grappling with right now.